If you're wondering why coin shops suddenly can't lock prices, why refiners don't want sterling, why payment delays and even price locks are getting longer by the week, and why I'm hearing they're not even taking gold jewelry anymore, it's not because business is slow. It's because price volatility has turned time into a liability. Refiners hedge production to stay neutral, but those hedges were never designed for $30 price moves. When volatility goes vertical, the hedge becomes the risk. And when that happens, the safest move is to stop taking material altogether. What we're watching right now isn't just a silver rally, it's the breakdown of a system that worked until it didn't. And once you understand how refiners actually hedge, you'll see why this ends badly for a lot of people in the middle. Gold and silver refiners don't speculate. They survive by moving material through time as fast as possible. The problem isn't price going up. The problem is price moving faster than time allows. Hedging wasn't about making money. It was about neutralizing the time gap between buying and delivering. As long as price stayed within expected bounds, the system worked. Years of deficits, exploding industrial demand, central banks buying, Chinese export constraints, and new investment demand. The assumptions hedges were built on no longer exist. Hedges are designed for volatility within a range. When price swings blow past that range, the hedge doesn't protect you, it exposes you. At that point, stopping intake becomes the rational decision. Lower purity means more refining steps. More steps means more time. In extreme volatility, time is lethal. Dealers used to pass price risk upstream. When refiners stop locking, that risk flows downstream, straight into the dealer's books. A lot of people started trading online during COVID and opened physical shops soon after. They never experienced how brutal fixed costs become when volatility explodes. Today's Saturday, January 31st, 2026, the end of January. It's been quite a volatile month, a volatile week in the metals. We had gold closing at about $4,890 and silver $85.25. Today's initial focus, there is a lot I want to talk about, but one of the things I've been focused in on that has drawn my attention essentially because you have a lot of big YouTube channels that have 100,000 subs, 300,000 subs, and they're always calling coin shops. They only seem to be sampling from that portion of the market, and they're calling up coin shops, and there's this shock that they're paying so much back of melt. And I wanted to talk about today the things that are driving that segment of the market. But before I do that, I would invite those channels that have so many subs. Why don't you sample from other parts of the market? I don't know if you are aware, there's a big group of folks on Reddit in Costco PM, r/Costco PM subreddit. These people are out there looking for deals. They're not going to coin shops. They're going to Costco. They're leveraging, there's certain cashback deals where you buy feeless Visa gift cards and then use your Costco executive membership, and they're finding locations where they're not changing the prices fast enough, and with all those cashback offers, they're buying silver and gold for a discount off of spot. So I ask you, why would this segment of the market go bother with a physical coin shop that has a higher fixed cost of selling coins, bars, whatever else? Why would they do that? I've been talking for a while now about peer to peer. There are people and groups on Instagram and on Facebook, and they are transacting at a with. I mean, you're doing something from home. You're transacting a coin from home. It's going to be a lot cheaper than a physical shop. You have a physical shop. We're now talking about you got to pay rent, you got to pay electricity, insurance, whatever else you have to pay. All these fixed costs of production, they have to sell for higher. They have to sell. What they offer you to buy from you, it's going to be lower than peer to peer or anything else. So I urge these channels that are constantly calling coin shops, come on, get more involved. Let's sample from other parts of the market. What I'm about to talk about, a lot of this information I got thankfully to AG Stacking. He's on Instagram. He's been around for a while and he does this peer to peer. He doesn't have a physical coin shop. He's always buying and selling. And so I want to thank him because a lot of the information I've presented thus far and I'm about to talk about, I got from him because he's sharing this out in the marketplace. He's sharing the difficulties that a lot of sellers are having. I mean, can you imagine like AG Stacking's talking about difficulty and he does not have a physical coin shop? Can you imagine the physical coin shops and what's going on there? So what I'm hearing from these big YouTube channels and what I'm hearing from AG Stacking and some others about these physical coin shops, that people are calling them up or going there in person and saying, "Hey, I want to sell an ounce of silver. What will you pay me?" And they're being offered $15 back a spot. And there's a lot that's going on, but I've always emphasized that when you deal with a physical coin shop, they love what I mentioned earlier. They have higher fixed costs of running that coin shop. They naturally are going to offer you less than anything else. There are other big YouTubers who are sponsored by online dealers, and I have seen on the subreddit of Silver Degen Club and Wall Street Silver where people went to sell, and on those online platforms, they ask, what are you paying for like 1 ounce of silver? And the offers are much, much better than what physical coin shops are offering. So here's my understanding of the market as it pertains to physical coin shops, local coin shops. This is what I've gathered from what AG Stacking has been sharing on Instagram and what some others in social media have validated, that your physical coin shops normally would operate. They buy from the public, they offer a certain amount for whatever it is, your silver, your gold, etc. And then they may sell a portion of that inventory back to the public and capture the spread. And what they cannot sell, they would then go to gold, silver refiners and they would sell that residual inventory. And normally they could go and lock in a price. There may be a lag of when they get paid to a refiner, but they could normally lock in a price. So a couple of factors over the course of many weeks have exacerbated what's happening to them. It's been laying a lot of risk on these coin shops. And essentially, first, it started with, sterling silver. They were not accepting sterling silver. Then a situation, from my understanding, that then they had to wait longer to get paid. It's escalated now where they cannot even lock in a price. They have to wait before the price. They have to give that residual inventory to the refiner, but the price won't be locked in. There was like a 7 to 10 day wait from what I have heard that they have to wait. So that introduces a lot of risk. And then the latest one was they're not even taking gold jewelry. So things are really escalating. Let me make something very clear. The end user, the industrial demand, and everything else, it's still there. They need the refined product, they need the refined metal. AG Stacking was sharing some information from a dealer who was on Facebook, and he said the cold, storm, snow, and everything else that kind of paralyzed huge portions of the United States have kind of played into this and kind of exacerbated this situation. Um, they were not letting airplanes full of metals fly out because the insurance companies were saying, no, it's too dangerous to fly planes with all this cold, all this snow. And that kind of paralyzed things. And I think that's what exacerbated then the refiners to tell coin shops, dealers, everyone else, we're not locking in price. You have to wait. From a refiner's standpoint, things are very risky for them because a refiner, like any other commodity, they're dealing with metals, gold, silver, platinum, etc. A farmer who's dealing with corn, wheat, soy, etc. They'll hedge their risk by essentially buying contracts on the futures market. But I mean, hedging becomes a risk when price goes out of whack and gets very volatile and starts moving out of the range it's normally moved, because a lot of things are happening. You're hedged for a certain price range. Not only that, when prices get too high and there's a lot of volatility, the premium to hedge becomes expensive, and that starts driving what the refiners are doing now. They can't protect their risk any longer. They're trying to essentially make a profit off the process of refining, and what they pay dealers to what they get paid from an end user. That's the money they want to make out of the operation. So they want to be net neutral on their hedge. They're just basically trying to protect that expected profit. But now, if the hedges become expensive and now they're a cost of production, it eats into the margin, and they're likely not to hedge. And then they're now telling dealers, sorry, you can't lock in price. Now you have to wait because time is risk for us. You must wait. All of this has physical coin shops really nervous. You know, I've been in the Instagram peer to peer community of gold and silver since 2021, and I've been able to observe folks similar to AG stacking, and they were seemed very successful. And because they were successful in online peer to peer, they thought, hey, I can make it with a physical coin shop. And I've seen several out there, and they've opened up physical coin shops. But I mean, I'm not sure if they've evaluated that risk thoroughly before undergoing that endeavor, because, like I mentioned earlier, physical coin shops, you have a higher cost of operation. You have many more fixed costs. And I'm seeing that they're anxious. I'm seeing that they're quite nervous. And it's a difficult situation out there, unfortunately, to the matter that I believe a lot of physical coin shops are going to have to close. The fact that online operations have a cheaper cost structure makes it easier for buyers and sellers to interact, transact from the privacy of their own home. They don't have to go to a physical coin shop. And I mean, I see a lot of online dealers, they're very successful. I mean, a lot of times I'll talk about AppMex, but AppMex actually is on the higher end of cost. They sell things for a lot more expensive than others. I've seen Monument Metals. They are very, very active on Reddit, on a Wall Street Silver, on Silver the Gen Club. They even do giveaways. They're very involved. So this is a really, really difficult time for physical coin shops. And I mean, I'm not trying to be a Debbie Downer. It's difficult. I wish them the best of luck. I mean, one of the things they can do to kind of mitigate what's going on is to just be very cognizant of what the public likes. For example, on PMs for sale on Reddit, there are certain items that just move like bam, just really fast. Like, they pop up for sale and they are buy it now within minutes. They don't even have a chance to catch air. Libertads, for example, they just vanish. People love them. So AG stacking sort of has a contrarian point of view on this. He sees that local coin shops, they're going to be a lot more reluctant to go to the refiner, because hey, if they cannot lock in the price, even though they'll have to wait for their payment, if they cannot lock in price, they're more likely to keep that inventory and try to sell it to the public. And then over time, in a contrarian point of view, if the refiners are getting less from dealers, from coin shops, then at some point they're going to interact a air pocket where they're not getting new inventory, and it got exacerbated because the refiner cannot hedge, and AG stacking expects that's going to drive up prices, and spot goes higher, it's going to exacerbate that increase further. Let's talk about market sentiment, because I have a lot to say about that. On CNBC, on Bloomberg, it was interesting. I was keeping an eye peeled out over the last year when I started seeing prices begin to break out, specifically silver, when it was about to breach its all time high. It was already showing signs, as I mentioned many times on this channel, on the monthly candlesticks, the quarterly candlesticks. It was showing that it was on the verge of breaking out. And I've talked about that in prior videos. And so I then started to watch Bloomberg more and CNBC more. I never cared for them because they're just advertising what they're they want institutions that want you to buy. They're selling their wares per se. And so I started paying attention as the breakout was happening, and they were not really talking about gold and silver, not that much. Things started to change in the latter part of December and January, where then it got talked about on a daily basis. So this is an asset class that the financial media channels are now only starting to talk about on a daily basis. Remember your AI stocks, all these chip stock semiconductors, they've been talking about them daily, nonstop for years now. And now we're talking, just starting to talk about gold and silver on CNBC and on Bloomberg. And this is the type of headlines you're getting from them. Silver heads for biggest drop in 14 years, with every man and his dog rushing for the exit. And I'm over here responding to this yesterday, seeing this in front of my screen, saying, who are all these men and who are all their dogs? Because I don't see them. So let me give you my personal reflections of what I've observed on Instagram over the last year. Silver started to break into the 40s. That started drawing my attention. And I said, this is finally could be it. Essentially because gold already began breaking out into new all-time highs in 2024. Historically, silver waits a little bit, but it can't wait forever. It's been about a year, and that drew my attention. And what I started seeing is a lot of Instagram people saying, "Oh, got to wait for a correction." That Pavlov puppy reaction that forever there's been corrections for years, for years, for years. So they have been conditioned that every time price hiked up like this and we saw a little surge, oh, the correction is coming. There was a lot of people selling, a lot of people selling, and it's going up. And I'm telling people in a couple of groups I'm in, I'm like, this could be the breakout. You may want to grab what you need now because it's going to break out. And let me tell you, for most of this price surge, a lot of these because you can have little private chat groups in Instagram and Facebook and everything else. It was quiet. It was as if we were at a funeral. So I don't understand how I can hear about every man and his dog rushing for the exit if most of the men and their dogs were not even in this for this ride. It was interesting to see the amount of cynicism that I experienced yesterday. And I mean, these were people I was sharing my thoughts, anyone that wanted to hear them, very openly. You can pull up my history on YouTube videos and all I talked about. I talked about this freely, but I always warn, the risk is on you. And there was a lot of cynicism that came through yesterday. Whether it was like inside social media or outside of social media, people sending text messages. I saw someone that said, "Oh, there's a massive dip. Why don't you buy it?" Well, why do I have to need at all to buy any dip? If I packed all my baggage on the train, I left with the train at the beginning when I left. I'm in for this ride. What you should consider buying in the dip. And for anyone listening who's thinking like, I'm new to this and now this investment thesis is making sense to me. I'm not a fan of telling someone, oh, just go and go all in and go at it. Dollar cost averaging is probably the best way just psychologically to enter a market, to deal, because we're now, and we'll talk about it again shortly. We're now in that final 20% of the secular bull market in the metals. And I mean, a secular bull market, we're not talking about, 5-10 years. This is a multi-decade secular bull market that started around the Gordon Brown bottom, which is when the UK sold all its gold reserves. That was kind of like the capitulation and started the secular bull. So we're in that final 20%, but it's 20% of multi-decades, so it's several years. So experiencing that cynicism, I mean, that was crazy. And I mean, if you're gonna get in, dollar cost average is the way to do it. It's just better for you psychologically. It doesn't have you anxious and thinking that I do the right thing or the wrong thing. So if you just dollar cost average, I think that's the best way to go about it. So if you've been following this channel, I've showed this chart several times. This is what I'm talking about when we talk about the multi-decade secular bull market in gold, silver, precious metals. I mean, the Gordon Brown bottom, it was not just one day in one year that it happened. It was between 1999 and 2002. So I have the year 2000 for simplicity's sake and just to give an idea. And I say 80/20 because it may not be exactly 80/20, but it's approximately what happens. In that initial 80% of the time, only 20% of the gains happen. And that final 20% of the time is when most of the gains, 80% more or less of the gains happen. And why? Because that's when the crowd comes into this asset class. The smart money gets in at the beginning when you want to ride with that crowd when it first shows up. So you know how I just talked about that cynicism I experienced yesterday? That's not a sign of the top. I've experienced the top. I meant for those that have been following, my first bull market was in titanium. Back, I hopped in 2004, and some people say, that was kind of late because people were getting in at around the bottom, at around 9/11 when aviation kind of took a dump. And I got in 2004, and in 2006, instead of cynicism, everybody was patting me on the back. So think about that psychologically. The day everybody around you pats you on the back, guess what? That means the crowd is all in. Time to start thinking about getting the heck out. So just to elaborate on this is just an estimate, the 20 and the 80, but typically it is that type of concentration. And then the time may not be exact. I told you the brown bottom was between 1999 and 2002. The 2030 you see on the screen as the end of this time frame, that's just the estimate. Maybe it could be 2028, maybe it could be 2032, but this is just an estimate. This is to give you an idea. I wholeheartedly believe we are now in the final 20% of the time. Here's one of many valuation metrics that kind of I keep attention to and monitor at all times. This is showing market cap as a percentage of global stock market. And I mean, if you're comparing today to prior tops in gold and silver market, 1980, for example, in the 30s, for example, I mean, the amount that the crowd has in gold is nothing compared to them. So if you have financial media advertising to you that every man and its dog is selling, I don't think so. This is not highlighting that at all. So I have highlighted metrics like the ratio of the gold price per ounce to the M2 money supply. And what I'm showing here is the gold ratio to the monetary base, the M0. And so to M2, the price to match the 1980 high is around 12,600 currently. And so you might say, this is one I monitor, and you might say, why haven't you presented this one before? And gets a little tricky. And just to explain it simply, for this ratio to kind of get to the levels of either 1980 or the 1930s, gold would have to be at 26,500. And you're wondering, like, well, if the price in 1980 was 850 an ounce, and that was a top based on the M2 money supply and the M0 monetary base money supply, then why such a difference? And so this is when I mentioned, all we need is a crisis and things can unwind fast. Basically, the monetary base includes all bank reserves. And all you need is a crisis. And you need liquidity getting pumped out. And that's when I think we might see a convergence of what the gold target in M2 money supply terms is, that 12,600, will start to converge to the M0 monetary base money supply target of 26,500. So I think we're just a crisis away of suddenly having completely different gold valuations to talk about a secular bull top. This one I was absolutely shocked to see this week. They let on Peter Schiff on a major financial news discussion. This guy has not been on for years. He was treated as essentially like a malignant neoplasm on CNBC, on Bloomberg, and everything else. So he showed up on Fox Business News, and it really drew my attention, especially what he highlighted with some other observations I've been piecing together. He essentially said that the next crisis, it's going to be a dollar crisis, not a global crisis. He said verbatim, this one is all in America. It's not going to be exported to the rest of the world. This was so interesting to hear Peter Schiff say this because I heard a story from my brother-in-law this week that he was talking to some people on online mobile games. And what I mean by online mobile games, there's a lot of these games out there. I was personally involved in some in the past. Specifically, I played Mobile Strike. I played Looney Tunes World of Mayhem. These are not games where you pay once and you play the game. These are games that, they get you hooked. It's called pay for play. Or essentially, if you want to play for free, you're not going to get much done in these games. And basically, they design these games to get you to get emotional and to spend, to get involved. I don't want to admit how much I have spent in the past on these games, but what I want to emphasize is the people that are spending on these games, they're not poor folks. They're people with a lot of money. And some of the dynamics of these games is that people in these there's groups within the game. They kind of set it up so there's alliances, there's matchups against enemy groups, and so this generates interactions where either on WhatsApp or on a Discord server, alliances are kind of getting together and kind of strategizing, how they're going to win, how to optimize the use of resources. And resources is what you ultimately have to pay with real money to get involved in these games. But I mean, just to give you an idea, when I played Looney Tunes World of Mayhem, it became knowledge amongst many alliances in that game. That whole idea of alliances is very common in a lot of these games. The top dog was a cardiologist in the United States. He was spending $5,000 a week on the game. It was insane the amount of money this person was putting into the game. That gives you an idea of the kind of money being spent, who's involved in these games. That game also had a CEO, an oil industry CEO out of Europe. And man, the one thing that was hilarious, I mean, I'm kind of trailing off left field here, was the amount of analytic effort in these groups. We had spreadsheets going where we're doing calculations to say, which Looney Tune has the best power for this situation, for that situation. It was absolutely insane, the brain power put into these pay for play games. But here's the interesting part. When you're chatting with these people, it's not all business per se, as in the game. People start talking about other things in life. And so what I had heard from my brother-in-law, who plays the Game of Thrones one in the Discord server he is in, they all know, hey, you're from the United States. Hey, maybe you want to get out of the US dollar. That was the recurring theme. People from different countries in Europe, from Australia, from all over the world, telling him, hey, maybe you don't want to save in dollars. So he found that quite interesting, and he shared it with me, and I said, wow. And now hearing Peter Schiff, same kind of idea. It's almost as the world is generating an overall distrust in the US dollar. So what Schiff is saying is kind of like, hey, this is what everyone else, Schiff's saying it, I'm hearing it from my brother-in-law, from rich cats all over the world playing a game. I mean, there's something going on here. My Libertad lovers and aficionados, before we get into today's featured piece, the 1988 1 ounce silver proof, I just wanted to say, first of all, congratulate WTXMD. I did the 1 ounce 1985 giveaway. He's the winner. Your package is all ready to go. It will be shipped out first thing Monday morning. Something else I wanted to talk about, because a lot of folks who collect Libertads are well aware the Libertad is one of, I don't think I'm not sure how many major mints are very active in fractional coins, but it started to draw my attention. Bullion Cat was talking about it now for over a year. He said, at some point when the price of silver finally starts to take off, we're going to see a surge in demand for fractionals. And so when you're talking about Libertads, that surge in demand, because it's such low mintage, causes a surge in numismatic price. But what I envision big mintages like the American Silver Eagle. As the prices climb higher, I believe they're going to start minting fractionals. They're going to start doing that, because then people are going to start thinking like, hey, the price of 1 ounce is a little too high. I don't know, let's say 250 an ounce, 250. Then they're going to say, that's kind of high. I don't know if I want to get in this. And to think about an analogy to the stock market where companies, they go to $1,000 an ounce, and that same precarious thought comes into investors' minds like, hey, $1,000 an ounce, that is a lot of money. And then they do a stock split, and then suddenly maybe it's $20 a share, and they're like, oh, okay, for $20 a share, I'll get in. I do believe the equivalent of a stock split is going to be that the American Mint will start minting a lot of fractionals. So without further ado, this is today's featured coin, the 1988 1 ounce silver Libertad. You're seeing two coins because this is a second variety of which we have talked about when we covered the 87s, the missing feather on their arms. But before we talk about it, what is quite intriguing about this one would have expected the edges, if we could see the edge on this, you could see it's reeded. It's not flat. We would have expected it's documented in the Encyclopedia of Modern Mexican Numismatics, Bailey's book, the volume 2, that it should have a flat edge, but with the engraving of Independencia y Libertad. But that's simply not true. They're all reeded edges. There is actually one single example of a flat edge of an 88 proof. I'd mentioned him before on my channel. He's a big Mexican coin collector, BC Treasure Hunter on Instagram. He actually discovered the one single graded example of a flat edge for the 1988. So it is unusual because, as we'll see in the next video, then 89 goes back to having a flat edge with the engraving. So that's interesting. The missing feathers, we have talked about that last time. Looking at the angel, us looking to the right, but it is the angel's left wing, and we'll show a close up in one of the slides coming up. That there's details of the feather. It should go under the arm to the torso, and there's missing feather elements there, and that's what this missing feathers underarm is all about. Let's take a look at the 1988 proof Libertad mintage. It is tied 9 total years here that you're seeing on the screen with 10,000 mintage, and believe it or not, 10,000, relatively speaking, is abundant for the 1 ounce proof Libertad series. There's as they say in Spanish, there's a cuento chino, which is kind of like a BS story that the Chinese came and bought a bunch of 88s, and they're kind of hiding in China. The same thing was said about the BU. I don't think that's true at all. I've seen no proof. I've never seen anyone from China post on social media stacks of 88 or anything of that nature. What is clear is the theme I've talked about in the past, that in the 1980s, and particularly around 87, 88, you had a huge devaluation of the Mexican peso, and we've talked about the dynamic in Mexico where Mexicans would buy silver to protect themselves from these not hyperinflationary but quite substantial depreciations of the peso. And so what I believe, years like the 87, 88, and even 9, a lot of these were probably sold off and melted because, as you see, all of these years here, the 88 and the 89 are the priciest ones, and we'll talk about what the comps have been going for recently. But the 88 and 89s have the highest comps, and the 88 a little more than the 89. As promised earlier, here is a zoom in on distinguishing the missing feathers underarm variety, and you're seeing it on the left side. So as you can see, some of the detail that other Libertads have, where the full wing is coming through below the arm to the torso, you're seeing those missing features there. It's not full coverage like you see here on the right side on the standard variety. So this is kind of how you can spot under magnification the missing feathers underarm variety. Let's talk about sold comps on the 88 proof. And so you won't see a lot of sold comps on eBay because this one doesn't come around too often. And that's highlighted by some of the price values you're seeing here. So the standard one sells for about $1,000 to $1,200. And then the missing feathers underarm variety, that one goes more towards $2,000 to $2,500. So that one is a lot more rare to find. Thanks for watching. Don't forget to subscribe, like, and stay tuned for more videos.